Welcome to episode number 17 of Daily Market Mastery with me, popular investor Christian Rauchenwald. As usual, in this episode or in our episodes, we're using Elliott Wave Theory to try to predict market movements, so where stocks are going to go in the more mid and long-term future. If you're curious about how all of this works, I recommend check it out or check out episode number 1 of Daily Market Mastery. There I dive a little bit more into like a or basic understanding of the rules of Elliott Wave Theory. And yeah, like besides that book is a good recommendation. You can use the link in the description down below to check it out online for free or to order a physical copy. And in the description you also find links to all the tools that I'm using, including the pushing a button, the one-page cheat sheet that we have here available that summarizes most or pretty much all of the rules for all the patterns that exist, to avoid or save us the time to always consult the book. Now, with that, let's jump back. As mentioned, usually in the past, we've started our episodes by summarizing what's been going on, but since we've covered quite a few stocks so far, it got to the point where our summary already took up most of the episode's length, which we're aiming to have around 30 minutes. Which also is the reason why I'm now going to start up a timer, stopwatch, and yeah. There we go, timer's running. So to keep this ideally in the 30-minute mark, maybe a little bit shorter to not overload people with information. And yeah, last but not least, before we jump into any analysis, keep in mind everything that I share in this video / live stream is my personal opinion and in no way financial or professional advice of any kind. You should always do your own research, consult certified professionals, draw your own conclusions, and make your own decisions. With that said, let's jump into it and start off with recent bank failures. So I'm sure you heard that First Republican Bank got now confiscated, and basically JP Morgan is buying up deposits and something like that. And yeah, like what surprises me, I mean, that doesn't surprise me because I'm gonna hide that message step. Yeah, that part doesn't surprise me, but what surprises me is if we look here, here's a comparison of like the 3 failed banks this year were bigger than 25 that crumbled in 2008. So if we look at 2008, that's the total sum, and those 3 failures alone already amount to more, and it's not the end. So if we look at yesterday, or look at banks yesterday, then we already saw that a couple of other banks are basically set up for the next failure. So with some of them already being down 70% year to date and so on. And so I'm fairly certain there will be more bank failures. Now, might that be a good opportunity to short banking stocks? Maybe, maybe not. I'm personally not super interested in that. But what's interesting to me is the fact that, well, yesterday the SPX 500 and the NASDAQ both dropped, which we can see, for example, if we check Motive Wave, we see that nice red candle here, and there should also be a nice red candle here once it loads. Okay, there is a little smaller. And despite everything that's going on, despite having like bank failures that already, eclipse with 3 banks alone, eclipse what happened in 2008, with more potential failures on the rise. Despite all of that, the market today is like like nothing happened. You can see SPX is basically up already 0.16%, was slightly up in the pre-market, and the Nasdaq is not here on my list, but we can see here the counter investment that we have that basically goes up when the NDX goes down and goes down when the NDX goes up. And so basically it's also up today, which it just baffles me. I mean, of course, one can say, well, the bank has nothing to do with things like, I don't know, Ford, where we invested in and so on, or Facebook or whatever. But at the end of the day, bank failures, in my opinion at least, mean like, okay, there is some trouble in the financial system. It means that resources from other banks might be challenged or strained, or however you want to call it. And on top of that, it might mean that then businesses get less funding. Yeah, like if we combine it with everything else, like the rise in interest rates and so on, I'm truly surprised that the recent bank failure of First Republic or First Republican Bank, is it First Republic Bank? Okay, my mistake, First Republic Bank. Doesn't have a bigger impact on the market yet. Maybe it comes delayed. Maybe the rich and mighty are bringing their sheep to safety before they allow the mass news media to actually spread the fear that is justified. Yeah, especially then if we let's see if I find that blah 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 news. Yeah, stock market future. No, I want to have like haircut on lock. So let's see. Nope. Was it DTC or the DTCC? Announcement on lock. Yeah. Okay, we don't find anything here. Interesting. Okay, let's just check regular Google. Blah blah blah. That's from yesterday. So, yep. So yeah, like there we have the tweet. Due to compliance concerns, DTC to apply 100% collateral haircut, zero value to all securities issued by affiliates of lock lenders effective today. So yeah, so effective May 2nd, so yesterday, DTC will apply 100% haircut and assign no collateral value to securities that are issued by an affiliate of any lender listed in Table 1 of Appendix A, lender banks to the joint DTC and NSCC committee, blah, 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 yeah? Which means basically that any collateral that you got from, or if you're using those values as your collateral, they now count as zero collateral. So you need to either add more funds to keep your margin requirements and so on. And the list of Appendix A is like Bank of America, Bank of China, Bank of this, Barclay, Bank, blah, 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 Bank. Yeah, I mean, Credit Suisse, yeah, I mean, by now Debit Suisse, obviously, yeah, Deutsche Bank, yeah, Goldman Sachs, HSBC, and so on. So we can see it's a prominent list of very, very big banks and smaller ones. And yeah, like, how does this not have a bigger impact on the market? So like, how not? Yeah, like I'm really wondering. So anyway, that's not what we're doing in the stream. I just wanted to share this piece of news with you guys in case you were not aware and haven't seen it. So we had another bank failure. By now, those 3 bank failures are actually bigger than what failed in 2008. If we adjust it by inflation, it should still be bigger than in 2008. Yes, we had one bank that was twice the size, or like if we look here, Silicon Valley Bank and First Republic Bank combined are like a few $1 billion short of reaching Washington Mutual Bank failure in 2008. Yeah, and the other 24 combined are basically less than Signature Bank failure alone. But overall, we are already with 3 banks already already beyond what happened in 2008. Anyway, now with that said, as usual, so how is our portfolio doing? Yesterday we had a positive day with, I don't know, plus 1 point something percent, based on markets dropping, since we're heavily betting against the markets, or not heavily, but to some extent. If we check out my portfolio, we can see that we have our ongoing positions. And again, we will not analyze those positions right now because that takes up too much time. But we're going to jump into the economic calendar and try to pick something from June that has earnings release to look at. So we look a month ahead. Why? Because Elliott Wave Theory is based on mass psychology. And then obviously things like earnings and so on are great events where a greater group of people might make a decision to either buy more, sell, hold, whatever. And therefore those would not always, but might give us a better chance to find a point where, for example, a stock moves from, I don't know, like a corrective wave 2 into an impulse wave 3. So giving us potential market entries. What do we want to look at here? So dividend payments, not that much relevant. Ford, we already looked at. Intel, not super interesting. GameStop earnings report is going to be at the end of June. We're going to leave that out. We already have a video about GameStop. You can check it out. It's one of the previous episodes. That's dividend payments again. We look for what's the color for earnings? Blue. Okay, blue would be Micron Technology. No idea what they do. Probably, and that's it. GameStop, and then a month later Micron. So there's not a lot of earnings here. Okay, if we jump a month ahead, JPM, JP Morgan Chase, they should actually have good numbers, considering that they stand to apparently make, like, I don't know, what was it, like 1 point something billion straight away from buying up the deposits and projecting 500 million per year in profit from buying up the back deposits of First Republican Bank. So, which translates, by the way, at least for me, that the taxpayers will be the backholders here. So the losses are like socialized, and the government is taking care of the losses, including, as far as I understand, the 50 billion or no 50 million. I don't remember perfectly, but like guarantee or security or whatever. Yeah. So anyway, so maybe not the best thing. Goldman Sachs, yeah, another bank. Morgan Stanley, yeah, Bank of America, Netflix. Let's take a look at Netflix. Yeah, so I said not a huge fan of the bank. So yeah, so Netflix and NFLX. Let's take a look. So new chart, NFLX. And there we go, Netflix. There we go. While it's loading here, we're also gonna fire up the same thing in Trading View. Do I already have Netflix here? Can I sort in by name? Yes, I can. And nope, no Netflix listed here. So NFLX, there we go, Netflix Inc. So why do we do that? We do that to make sure that our data source is correct. So let's get rid of what we have here. Remove one drawing. We see we have data here from 2002, and we have data here from, let's go to the monthly chart, 1 month, from 2002 roughly. Yeah, so what was it, Alt B? Yep, there we have cursor data. Thank you very much. So from 2002 we have data here. Now if we look up, we look like this, that looks very, very much like an Elliott Wave pattern. I mean, obviously we should look at it in the logarithmic view, but we can easier spot the pattern here. If we have, I don't know, could be 1, 2, or could be 1, 2, then we have a wave 3, 4, no. Then extended fifth wave could be 1, 2, 3, 4, 5. Could be 1, 2, 3, 4, 5, but most likely 1, 2, breakout from the base channel, corrective wave 4, and then wave 5 with 1, 2, 3, 4, 5. Yeah, that subdivides like this. Yeah. If we check here, so just to make sure the price levels that we have is also correct, the low here is at 0.3464, and the low here up. Okay, now we have to 0.69. So okay, our data is not perfect here because apparently there was a split somewhere that is not properly corrected here, which makes it a little challenging, but not too hard. We can see that here it's basically, we look at logarithmic scale, so we can see it's up, down, but we don't have a new low, further up, down, we don't have a new low, further up, down, and now we're here. Yeah, so that's what we can see here. Now in comparison for us here, that part here just, so here somewhere we have a mistake. Yeah, so in our data, which is important to know. Yeah, we can still now just let the auto labeling take care of. We take the oldest low that we have here, and it would say something like this, yeah, which is important because now we can also say, okay, hey, decompose that one level for me. I would say like this, yeah, that doesn't look like a natural wave pattern. Problem is our beginning here is a little bit wrong, so the auto labeling will definitely have a problem. However, that this is wave 1, and that we're now in wave 2 of some extent, we can get ring of this, we can get rid of this. Yeah, like no doubt about that. Now, let's actually quickly use Kennedy channeling technique here to figure out where we're at. Yeah. So might actually be problematic because if this is our starting point and that would be 1, 2, then our base channel would look like this, and we don't have a breakout from the channel unless we do like this, and then we would have a breakout here. Okay, that also doesn't get us anywhere right now, so that might be a little bit more work involved than usual. Yeah, so we usually would have wave 4 is never the shortest, so I would tend to say, and wave 3 is usually, but not always, the strongest. Wave 3 is never the shortest, sorry. So I would usually say, or tend to say, okay, this is it. Although there it says terminates within the range of wave 1. Now let's double check that, which is not true. So we see here that the low here is 758, 776, so 754, and the high here is 568. So that's where our data is wrong, thanks to our interactive broker. So if we would listen to this, hey, that's not valid, but actually that checks out because those candles all here should be lower. Again, that's 1027 when it should be 568. Yeah, so pretty much half. Yeah, which would bring it far below that part here, which would also, it makes it really tricky now, but technically our base channel would here be at, what did we say, 5, are there settings to set the price here? Nope. Okay, so basically our base channel would be 0.0, which would be not 0.69 but 0.34 or so. So if we can get at least the right channel, can I edit that price somehow? No, I cannot. Okay, that might be worth a feature request. Edit, undo, copy, paste, delete, properties. Properties just gives me that, but I cannot select the coordinates here. Well, it's a little bit of a bummer. Okay, 0.34 would be our 0.1, and our 0.2 would potentially be this low here. Although AB, yeah, potentially this low here, which is at 127. So which would be this point here, but we need it at 127. Oh no, I looked at high probably now, so sorry for that. No, low 127. Okay, we get the same issue then here, of course, that our base channel shoots too high. Okay, so that doesn't help us here either. Anyway, so that is how I would label it. If somebody has an idea how to break it down, especially considering that our data here in the beginning is wrong, question would be at until where. So here actually the 127 seems to be correct. So there we have a low of 127, and here we also have the low of 127. So just that part here with the high here being 568. So only the prior candles here are wrong, yeah, for some reason, yeah. Now the big point is, if this here is wave 4, which stands to reason because after that we do not have any reasonable big corrective pattern to say, yeah, well, here we have a fourth wave, then we usually, okay, and there we're gonna have another challenge with the starting point, because again, we want to have 0.34 as our starting point. So close yet so far. 37, come on, we can do it. 34. So that would be our like Fibonacci retracement, where again, keep in mind, like, so the second wave very often retraces into the area of wave 4 of the impulse wave of a lower degree, which would indicate that we're looking towards 35.70. Do we get price levels here? Okay, if we adjust it a little. So changing the cursor, drag, so which would indicate that we're looking for the 35.78 range. Oh no, sorry, 776, my mistake. So and additionally to that, we would expect at least a retracement into, did we actually go, do we have 776 here? So I'm like, it's tricky to just 770 low, 754, 758, 776. Okay, a few candles earlier. So that would actually need to be on this candle, and then it would be 754. Yes, that checks out. Yeah. So we would expect a retracement in the area of wave 4, which would put us already like close to 38.2, but potentially also, again, area of wave 4 would be the 754 here. 61.8% retracement would also be fine, which would indicate that we, yeah, like go to $6. So that would be two things that would tell us, okay, that's where we're going. Yeah, no guarantee that that's going to play out like this. And obviously we're looking at a 20-year horizon here. So if that's true, it would not happen next week or next month or in 2 months with the earnings. So it's not going to drop down like a rock to $6. Yeah, but it would also need time to play out. So we're talking again about a multi-year outlook. However, considering how this played out, we can also actually, yeah, let's do that. Practice something that I'm not that great at, and that would be ratio analysis, which is in the book in, where do we have it, 120 or something like that. Historical, so 135 is, I think, where it starts, somewhere in that range. So there we have ratio analysis, yeah. And then if you're reading the book online, then you have to look for chapter 4, ratio analysis. If you're reading the physical book, it's page 137, blah, blah, blah. So there we have, like, unless wave 1 is extended, wave 4 often divides the price range of an impulse wave into the golden section. In such cases, the latter portion is 3821 of the total distance when wave 5 is not extended, as shown in figure 4.6. 4.6 and 6.1 when it is. So when wave 5 is extended, then technically, and that's the interesting part here, then technically the fifth wave, so like look here, I mean, again, you can consult the book yourself online or whatever, but I'm going to try to hold it closer. Then wave 4 to wave 5 makes up 0.618, and wave 1 to wave 4 makes up 0.382. Yeah. Now, if we, and for that, again, circling back to the screen, and I'm moving my Kitty bookmark. If we look here, you can see, I'm going to also get a horizontal line real quick so that we just, try to put here and extend. Then you can see that we are roughly in that area. So wave 1 to wave 4 are counting from the bottom, from our 0 point. And our 0 point is lower than the chart because that's where the price actually was. So our data here is wrong up to this point somewhere. And so if we look here, we actually have exactly the breakdown that we say, okay, this makes up 38.2, and then wave 5, so wave 4 to wave 5, because it apparently is an extended fifth wave, makes up the other 61.8. So that, while not on its own conclusive, would confirm or lend credibility to the idea that this is 1, 2, 3, 4, 5, and we're now in a wave 2 on the way down. And if we are here in a way down, we would usually expect a zigzag that could or could not look like somewhere this, although wave 2 would need to go there, and eventually, probably we're gonna move that point further. So again, so somehow like this. I'm gonna just drag that out a little so we actually see wave patterns. And I don't know why they don't align well here. There we go. And which means we would be in the beginning of wave A if that turns out as a zigzag, which means that this would divide into, and for that we can use our one-page cheat sheet. That's why it's so great. Deskcam, there we go. Would divide into an impulse or a leading diagonal. Now, if this here, so that zigzag and a zigzag first wave A is an impulse or a leading diagonal. So if we switch back again, then we can take a short look and basically take an impulse pattern here. And we would, or before we even do that, we actually are going to grab another Fibonacci retracement, bring it on the chart. In this case, we would say, okay, and switch to, what was it? The select tool, like this, So, and switch to looking at this part here, and we're gonna zoom in on that as well. So if we, not like this, I wanted to drag you further, there we go. We would expect, again, like for the second wave here, to retrace into the area of wave 4 of the impulse of a lower degree. We would have to look closer, we will do that in a second, to see if that's already a complete impulse. And then that would be wave 2, which would go to 38.2 or to 68, so anywhere between 38.2 or 61.8 are the usual areas where it then ends and we move further, which would indicate that that potentially could be wave 1, wave 2. Now let's, oops, wrong button, misclick, there we go. Now let's look closer, 2-day chart, zooming out. A lot of things might now be misaligned a little bit. F5, does a great job fixing everything, just not my trend lines, So, but if that were the case, we would need to be able to say, hey, this here has to be a wave 2. Not sure if it mentions, so that here has to be wave 1, 2, 3, 4, 5, and potentially it is, potentially. So we have like wave 1, 2, then we have a strong wave, then we have a correction again, so which is wave 4, and then we have a fifth wave that in this case starts with a huge drop-off. And obviously wave 3 is not the shortest, so like I'm not saying that it guaranteed is like this, but it looks on first glance to check out, which means what would we expect here for Netflix? Actually, we would expect Netflix here to, when do we have the earnings? The earnings are, as said, like in a month or so, to basically probably have bad results, and then we would end or go into further downwards movement. Now the question would be, is this already wave 2 completed? because again, it could also be that we see a little bit further retracement here, which would mean growth in this case, since we are looking at an overall downwards direction, which means every time we say corrective, we actually mean upwards. And when we say impulsive or impulse, we mean downwards, because that's what we're looking at right now. And in this case, that here would play out, yeah, like, I mean, it could already, we already hit like basically the 38.2, the 50%. It could still go a set further. And there's no set rule that says it always turns around 61.8%. It's just like, let's say, rule of thumb or whatever the right English phrasing for that would be. And yeah, potentially there's still a little bit of upside, although the overall trend I would expect to be down. And yeah, like, I know it sounds scary to think about, oh, Netflix gonna go down in the below $10 range, yeah, or even if we say it goes down to the $40 range, we're talking about a huge wipeout of value. But that's what, yeah, like my prognosis here would be that, and I might turn out to be completely wrong, of course. Yeah, like, I hope not. And I'm like, yeah, so yeah, yeah, I hope not. Like, that's the point. But that's what, if my labeling here is correct, 1, 2, 3, 4, 5, then the long-term outlook would be for Netflix to first of all suffer hugely before we potentially would then see new highs. Now, again, like the below $10 range, like, yeah, that would be something hard to believe. But to be fair, even if I would say, okay, it will go down to 38.1 or 38.2 retracements of $38 per share, it also would be pretty much a 90% or almost 90% reduction in value. So I don't think anybody would be that it makes a huge difference in that forecast case. Yeah, we'll have to see and watch, to be honest. So I'm gonna get rid of this retracement here. Oh no, actually, yeah, we can keep them. Can I move that one backwards? Maybe it makes, nope, doesn't work like this. Okay. So let it have it like this, or have it like this, Yeah. So, and move maybe that one a little bit further even. So yeah, so we'll have to keep an eye on Netflix here to basically see if how it moves. But to be fair, I mean, it already dropped from like almost 1,000 per share. So what do we have here? 700 per share down to 164, which probably also some people thought might not be possible not too long ago. Now it recovered, so it made 100% return to the 320 range, which is great. And now let's look if I can short Netflix actually. I can actually short it, yeah. And so if we were to short it right now, our stop loss is, yeah, like, would be potentially in the 402, but it could go higher. So if I were to do that, 402.72, 402.72. Okay, that would be 25% risk, whereas our, let's assume this here is already wave 1, 2 finished. So with basically, we would say that this is here our base channel. Oh, sorry, that is our base channel. Then our price target would be around $100. I mean, that would be our first price target, yeah. And actually, our real price target would still be, yeah, like, what do we have here? What do we have here? 754. The problem with shorting, and that's like the thing, is like that your risk is, while your profit or potential profit is limited, your risk is actually unlimited, yeah. And do I want to do that here? Yeah, so we would have 25% risk for like usually 1 point something percent of the portfolio value that we would invest. So that would mean like a 0.3% risk to the portfolio with 100% potential reward. That seems not worth it. Like, I mean, we're they're put options, so like not using eToro but using some other like interactive broker and getting put options might be worth much more in terms of return. Obviously, it's much riskier with options trading, blah 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 and whatnot. Yeah, but it seems that yeah, like they're, I don't know, like it's a 1-to-4 risk reward ratio, and yeah, I'm not gonna do it. So like I'm not gonna do it. It's not that I don't think that it will turn out, but considering how we started today's episode by pointing out, okay, despite all the bad news that's going on in the market, markets today are actually wrong button. Markets today are actually recovering. Yeah. We're gonna keep this chart open and gonna monitor it a little. And if we get a breakout to the bottom here to indicate, hey, that we're just in the 1-2 now wave 3 phase of wave 1, and then wave A would actually drag out further, obviously, in terms of time. So it might then look like this, 50, yeah, like this. Yeah. Then we might short it once we have a breakout here. So obviously that's still already a huge drop. I might also look into getting some put options here, because then I just have to risk the money that I pay for the options. And if I'm right, cash in hugely. And if not, then just lose the money that I paid for the options. But yeah, so Netflix, in my opinion, bleak outlook. Whatever the reason for this might be, maybe I don't know. Like, yeah, I mean, we'll see what will cause it, or if it will happen. And yeah, with that, we already are at the 30-minute mark. So that's it gonna be for today. Now, last but not least, I understand that some of the forecasts that I'm making might sound ludicrous, crazy, whatever. Yeah, and you might disagree with them, which is perfectly fine. However, I would ask you to, since this channel is focused on Elliott Wave Theory, if you disagree with them, try to apply Elliott Wave Theory and yeah, prove me wrong in terms of pointing out, hey, your pattern is invalid because whatever, this is not an impulse wave, this is like only the first 3 waves or whatever. And so that we basically stick on the topic to improve labeling with Elliott Wave Theory. That said, Elliott Wave Theory, while fairly accurate, is also extremely flexible. So in any given situation, there might be 2 or 3 patterns that appear to be valid at the moment, and only after we have a few future candles, we know which one will definitely be, or is definitely the right one. Which doesn't mean that it's not like able to forecast. It just means that it also doesn't, or will not always give you 100%, okay, this is going to happen. And therefore, it can also turn out wrong. The real secret, or the real benefit with Elliott Wave Theory, in my opinion, is that it gives you not just an idea of like where things are going, but also gives you an idea in terms of which price targets and entry points you can aim for. Yeah, but anyway, let's wrap it up for today. So that's it. Thank you all for tuning in, or if you're watching this later as a recording, thanks for watching the video. Don't forget to like, subscribe, blah, blah, blah. And yeah, and if you have any doubt about my performance, feel free, use the link in the pinned chat message or in the description down below and check out my historical performance and my portfolio to see how well I've been doing with Elliott Wave Theory over the past couple of years, despite, doesn't matter if it was a bull market or like last year, bear market. And then, yeah, like maybe consider it as well. Anyway, have a great day. See you all tomorrow with another episode of Daily Market Mastery.